If I talk about one of the best selling investment products in our country, policies by Life Insurance Corporation, LIC policies undoubtedly would be somewhere close to the top. Large number of people have been investing in the LIC policies, but how do they fare when compared to pure investment products like mutual funds? Which of the two is better to invest is what we are going to discuss in today's video. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of investing and personal finance. So let's get started. We'll begin with understanding the basic difference between the two. Most popular policies by LIC are endowment plans. These are basically traditional life insurance policies. Now there are two parts to the policy. One is insurance, the other is investment. Insurance is simple. If the insured person dies, the family gets the sum assured. However, as far as the investment part is concerned, it generally offers fixed income like returns. So if the policyholder survives the tenure of the policy, he gets a fixed sum plus some bonus. Let's understand with an example. Now we'll take an example of LIC new Jeevan Anand plan here. Anyone between the age of 18 and 50 years can buy it for a policy term between 15 and 35 years. And the age of the person at the time of maturity should be 75 years or lesser. Coming to the insurance part, the minimum sum assured or life insurance cover you can opt for with the LIC's new Jeevan Anand plan is 1 lakh rupees. And there's no limit on the maximum life cover. In case of LIC new Jeevan Anand, there is both maturity as well as death benefit. So if the policyholder dies during the term, the nominee or family member gets the death benefit. But if the policyholder survives, sum assured is paid to him or her as maturity benefit. Now it has another benefit which makes it so popular. If the insured person survives the policy term, he or she is paid the maturity benefit. But the life insurance part still continues even after the maturity of the policy. So if you survive, you get the maturity benefit, and on your death, eventually the family will get the death benefit. That is what LIC calls as the twin benefits of maturity and lifelong insurance cover thereafter. Now next, let's understand the death benefit and maturity benefit. Let's take two cases here. One where the policyholder dies during the policy term, and two where the policyholder dies after the maturity period. So in case of death of the policyholder before the maturity of the policy, the nominee or family members get either 125% of sum assured or 7 times annualized premium, whichever is higher. Plus the bonuses accrued during the term of the policy, plus the final additional bonus. So if we take an example of Suresh, who has taken a life insurance policy of 50 lakh rupees, the assured death benefit will be 125 times sum assured. It comes out to be 62.5 lakh. Plus additional bonuses accumulated every year during the policy term, plus final additional bonus if there is any. Coming to case 2, if the insured person dies after maturity period. Here the insured person will get the maturity benefit and the family members will receive the death benefit. Let's look at the death benefit first. In case of death after the policy term is over, only the basic sum assured is paid to the nominee. So in case of Suresh, that will be 50 lakh rupees. No bonuses are paid. Coming to the maturity benefit. So what kind of returns you will make with your investment in LIC new Jeevan Anand plan is what we'll see here. So if you survive the policy term, you would receive basic sum assured plus bonuses accrued annually during the policy term plus final additional bonus if any. We did some calculations to find out the approximate returns on LIC new Jeevan Anand policy. Now here we have made certain assumptions which are on your screen. We have taken the person aged 30 years, policy term is 20 years and sum assured is 50 lakh rupees. And the person survives the policy term. Now coming to the bonus part, we have taken a yearly bonus of rupees 46 per rupees 1000 of sum assured. This is the average of the last 3 years of actual bonus declared by LIC. So the calculations are on your screen, and based on the same, the XIRR of the product comes out to be 4.7%. That's around 5%. Now there will be a final additional bonus as well that will be paid to you at the time of maturity. That may increase your returns slightly, but since it's not guaranteed and depends on the profits of the fund, we have not accounted for it in our calculations. So here we can see through our example that traditional LIC policy, which is quite popular, is offering a return of around 5%. Of course, there is an insurance benefit. In case the person survives the policy term of 20 years, he or she will receive a sum of 50 lakh plus 4 lakh 60,000, that is 54 lakh 60,000. Now let's look at mutual funds. So mutual funds are pure investment products which invest either in equity, that is stocks of companies, and debt instruments as issued by government and corporations. But as far as comparison with LIC policy is concerned, we'll go for equity funds. Why so? Well, LIC policies are long-term in nature, say 10 years, 15 years, 20 years and so on. Coming to mutual funds, equity funds are suitable if you are looking to invest for such a long period of time. So if you look at Nifty 50 TRI, the broad market index that represents the largest 50 companies of our country, it has delivered an SIP return, that is XIRR return of 14% over the past 20 years, which is way higher than around 5% delivered by LIC endowment plan. But here you may argue that one doesn't get insurance by investing in mutual funds. True. So to make an apple-to-apple comparison, we must show how LIC policy will fare against a mutual fund plus term insurance plan. So the term plan will cover the insurance portion. For those who don't know, term insurance is the plain and the cheapest form of life insurance. How it works is, if the insured person dies, the insurance company pays the sum assured to the family members and the policy ends. In case the insured person outlives the policy term, nothing is paid. So in the above example, we are paying an annual premium of 2,86,000 for an insurance cover of 50 lakh rupees. Now if we have to buy a term insurance cover of 50 lakh, it will cost around 7,170 per year for a 30-year male for a policy term of 30 years. So this will leave you with 2,86,000 minus 7,170 equal to 2,79,000 rupees. Now this will help you do a monthly SIP of 2,79,000 divided by 12, which is equal to 23,250 rupees. So if you had done SIP of 23,250 monthly in Nifty 50 TRI index, you would have accumulated 2.6 crores in the same time period, which is way higher than 54.6 lakh accumulated through LIC policy. But well, the higher returns come with higher risk. Equity mutual funds are riskier as compared to the LIC endowment plans. So which one would you prefer to invest in? Do share with us in the comment section. This wraps up this video. Don't forget to like and subscribe to our channel, and we'll see you with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.